Good afternoon, and thank you all for holding. All participants will be able to listen only until the question and answer session of today's call, at which time if you'd like to ask a question, you can press star followed by 1 on your touch-tone phone. You will be prompted to record your name prior to asking a question. Also, today's call is being recorded. If you have any objections, you may disconnect at this time. I would now like to turn the call over to your first speaker today, Ms. Irene Stricky. You may begin.
Great. Thank you very much, and thank you everyone for joining us on our Finex webinar today on measuring financial well-being. We're very excited to have you all here today. We had a big number of people RSVP, so we're very excited about that. A lot of energy and around and interest in this topic today. Our speakers will be Genevieve Melford from the Office of Financial Education and Hector Ortiz from the Office of Older Americans. I'm going to do a few intro slides to get us started, and then we'll go into their presentations. And also thank you everyone for your patience with our webinar platform. Hopefully those of you who haven't been able to log in did get the slides that I sent so you can follow along. We are planning to change to a system that works better very shortly, but not quite in time for this call. So thank you for that. So I will do our standard disclaimer. This call is not legal interpretation, guidance, or advice. And the opinions stated are the presenter and may not represent the Bureau's views. Quick overview, for those of you who've been on CFPB Finex webinars before, I always do the first couple of slides, same few slides, just to get everyone comfortable so you know you're in the right place. And so just a quick overview about the Bureau, relatively new federal agency that helps consumer finance markets work by making rules more effective, enforcing those rules, and empowering consumers to take more control of their lives. And obviously it's on the empowering consumer side that we're kind of talking about today in terms of helping consumers manage their financial lives. And then just quickly, within the consumer-facing side of the Bureau, there are 6 offices. The Office of Financial Education is one of those offices, but we work closely with all the others, dealing with special populations such as older Americans, service member affairs, students, financial empowerment, which is our office working with economically vulnerable clients. And in particular, today's topic was done jointly with the Office of Older Americans. And our standard word about Finex, presumably most of you are in it since you have been getting these emails, but if not, you can email the email box cfpb_finex@cfpb.gov and say that you want to join. We have regular webinars, regular newsletters, some in-person convenings that we're doing around the country, and we're also doing surveys and trying to learn back from all of you what you're doing. So we're very happy that so many of you have joined and are participating in Finex. And also on a standard slide, we do have the resource inventory on our website that has all the tools and resources from the Bureau for Financial Educators. You can get to it at the URL at the top of this slide, consumerfinance.gov/adult-financial-education. And actually this is being updated, will be out the next week or two as a revised resource inventory with all the new things that have come out since the first version of this 6 months ago. Lastly, we encourage you to join our Financial Education Discussion Group on LinkedIn, where we both post Finex and other Bureau materials and urge all of you to post as well. I know a lot of you are in that, and I hope more will join. And I'll just note, we do have webinars the 4th Thursday of every month. Our next one will be February 25th. We are close to nailing down the topic, so I don't have an announcement about that yet, but we will continue with our monthly webinars. All right, with that, we will turn to our presenters. I will just say one thing. We'll have the presentation first. If you have questions that are kind of urgent or clarifying questions, you can feel free to email them. There's a little Q&A box at the top of your webinar screen if you are in the webinar, and I will be monitoring those throughout the call, and we'll post those to the presenters as needed. And then when the presentation's finished, we will open it up for voice questions. So even those of you who are on audio only will be able to ask questions at the end as well. So with that, that's our housekeeping. We will turn to our presenters. First, Genevieve Melford, and to be followed by Hector. Go ahead, Genevieve.
Thank you very much. Thank you all for joining us to learn more about the CFPB's new tool to measure financial well-being. Before I say anything else, I did just want to flag for you all that pretty much everything Hector and I will say today is covered in the publication that you see on your screen there if you're looking at the webinar. It's called Measuring Financial Well-Being, a guide to using the CFPB Financial Well-Being Scale, so don't feel the need to take any furious notes. We'll present this all to you now, and we're delighted that you joined us, but if you want to refer to any of the material that we talked about, you can see this user guide on our website at consumerfinance.gov/financial wellbeing. So with that, as Irene said, I'm Genevieve Melford from the Bureau's Office of Financial Education, and I'm so happy to be here with my colleague Hector Ortiz. Our ongoing research to better understand how financial education and empowerment efforts can improve the financial well-being of consumers is a joint effort between our two offices in partnership with the Bureau's Office of Research. So I just want to mention this is part of an ongoing research partnership between financial education, older Americans, and Office of Research. So,
and we are now on slide 9 for those of you following at home.
So before we go into the main topic of today's presentation, which is a tool to measure financial well-being, I want to just take a minute to give the background of the project for people who are entirely new to this with us today. The bottom line is that in order to advance our financial education mission, we need to understand what effectiveness means for financial education initiatives. That is, what success looks like. And we've taken as our guide for this work the growing consensus that the ultimate and common metric of financial literacy and capability efforts, diverse as they may be in practice, is improvement in financial well-being. That is an ultimate and common goal regardless of the diversity of approaches. And so we have engaged in a multi-phase effort to define financial well-being from the consumer perspective and then create a way to measure it. And that measurement tool is something that we would intend to be able to be broadly used by both practitioners and researchers. So next slide, please.
Yes. Slide 10.
Yeah, thanks. So more precisely, what is this new scale intended to measure? In the first phase of our research, which we published in January of 2015, if anyone wants to read that in more detail, that's a publication called Financial Wellbeing, the Goal of Financial Education, that is also on our website and talks about that phase 1 research in much greater detail. Here I will just tell you that in that phase of research, we conducted open-ended one-on-one interviews with a broadly diverse group of consumers around the United States, as well as a wide range of financial professionals like you all, financial educators, advisors, planners, coaches, tax preparers, credit counselors, and all of those interviews were intended to help us learn what financial well-being means to consumers, what it really means in their lives, and to ensure that the factors we identified were broadly relevant across adult consumers in the United States across life stage. We interviewed consumers aged 18 to 95. And in short, what we learned from that work was that financial well-being can be defined as a state of being wherein a person can fully meet current and ongoing obligations, they can feel secure in their financial future, and they're able to make choices that allow them to enjoy life. We also learned that that state of being is not strictly aligned with income level. It's not just about having money, people told us. It's also about managing it. The definition has 4 elements. First, having control over day-to-day, month-to-month finances, which really just means being able to comfortably meet your ongoing obligations. Second, it means having the capability to absorb a financial shock, and we learned that that can be achieved via a combination of savings, credit, and the safety net of family or friends. Third, it means being on track to meet financial goals, whatever they are for an individual, and people in different life stages or circumstances have different financial goals. And fourth, having the financial freedom to make choices that allow someone to enjoy life. And the specifics of what that freedom of choice means for individuals are notable in their variety. And I want to emphasize this here because in coming up with a measurement scale, we had to figure out a way to measure a construct where the specifics can vary a lot by the individual. So I'll just emphasize that individuals, we learned, value very different things. That freedom of choice can mean being able to be generous with family, friends, and community. It can mean having the ability to go back to school or leave a job to seek a better one. Or it could mean being able to work less to spend more time with your family. So that sort of variety of what people want to be doing means that traditional measures such as income or net worth, while very important, cannot fully capture all of the elements of financial well-being as we heard about them from consumers. Okay, next slide, please. Another way to describe what we learned about financial well-being is that it means that your financial situation provides you with both security and freedom of choice in the present and for the future. And this concept, while grounded in a person's financial reality, is inherently subjective because we learned that a sense of financial well-being is related to an individual's personal goals and preferences. And this subjectivity is a purposeful and important part of the construct, of the concept of financial well-being, and you'll see that reflected in the design of the measurement tool. Okay, next slide, please.
Okay, slide 12.
So once we had a clear definition of financial well-being, so that's the definition I just provided, we turned to developing a tool to measure it. And we had a number of goals for the measurement tool, and these included that it would reflect the consumer perspective on financial well-being, that it would be a highly reliable and valid measure of this construct. That means that it should provide consistent results if what's being measured doesn't change. And also, so that's the reliable part means that it should provide the same kind of score again and again if the underlying thing you're measuring doesn't change. And valid means that it actually measures the construct it's supposed to be measuring. And finally, we wanted this tool to provide the ability to produce a financial well-being score that is relevant across adult ages and contexts and directly comparable across consumers in different circumstances. For any of you who have tried to think about standard metrics, you'll know that this is a particularly fundamental and challenging thing to do, and it requires that this measurement tool be able to account for variation in individual preferences and circumstances. Our office, the Office of Financial Education here at the Bureau, is charged with engaging in financial education activities and being concerned about the financial decision-making capability of all American adults. So we really came at this from a perspective of wanting to make sure that it worked for everyone, not to mention the fact that we have a particular interest due to our partnership with older Americans to make sure that in particular what we come up with is appropriate and relevant for older adults as well. So we learned from our consumer interviews that financial well-being is a multifaceted concept. You may remember there were these 4 sub-elements, and that due to the inherent subjectivity of the concept, a given person's financial well-being is not directly observable to anyone else, to practitioners or to researchers or anybody other than the person themselves. Now, a scale is a term that you all may not be familiar with in the sense that we're using it today. By scale, we mean an instrument that is used to measure something that is not directly observable, such as an attitude or ability. So for us, it was really the natural choice to use to measure financial well-being once we learned more about what the consumer perspective on financial well-being was. A scale is made up of multiple questions. So part of the definition of a scale in this sense is that it's always more than one question, and it also incorporates a scoring procedure, a procedure to produce one score that incorporates answers to all the questions. Next slide.
Okay. Slide 13.
Okay, well, I feel like I'm moving along nicely, so I hope you don't mind if I pause here for a minute. Irene warned me that the audience for today's webinar may not really want to get into the weeds of the methodology, so I'll ask you to bear with me for a minute here. I want to at least give you a sense of the care and the scientific methods that went into creating this measurement tool. Hopefully, you'll never need to explain to somebody else everything that we did here, but I do want to give you some confidence in it before we describe what it is. So first of all, we worked with the same terrific team of subject matter and scale development experts that helped us create the consumer-driven definition of financial well-being. So the team for phase 1 and the team for phase 2 were one and the same, and they were very purposefully linked in their inquiry. That contractor team was led by CFPB and included the UW-Madison Center for Financial Security. Vector Psychometric Group led the development of the scale model and scoring procedures using methods based on item response theory, or IRT. IRT is primarily used in educational testing and psychology, and it provides a scientific method of creating especially precise estimates of unobservable characteristics, which is why we were thrilled to be able to work with experts in that for our scale development.
And Jen, the SAT and the PSAT are basically
Right.
scale,
all the standard
item response theory, right? Just to give people a sense of.
Absolutely. Thanks, Irene.
Just something they're familiar with, even if they don't realize.
Right. So I would say, the IR team methods, which allow individual responses to individual questions to contribute differentially to an overall assessment. That's the hallmark of item response theory, and that's what's used in most standardized educational testing. Absolutely. So a 4-stage process was used to select the 10 questions that make up the scale, and I promise you those questions are on the next slide. I won't keep you from them much longer. So first, a large pool of almost 50 potential questions was developed based on the consumer interviews and a review of related questions used in other surveys to date. So that means that we really thought about how did people talk about financial well-being in their own words. What are ways that we might be able to ask questions back to consumers related to what they initially told us and what we understand financial well-being to mean to them. So we wrote a bunch of items. We pulled items from existing surveys on related topics. That's how we put together the first big pool of potential questions. Then we tested those questions through a process called cognitive interviewing, which means that we asked people who were totally, unfamiliar with the process, not connected to the project, and a diverse range of people to read the questions, explain what they thought the questions meant, and explain how they would answer the questions and if they found any of the language confusing. So some of the questions from the initial pool were then revised based on the findings of those cognitive interviews. So that was kind of the qualitative part of the scale development process. Then we moved to the quantitative analysis. The large pool of candidate items was then fielded through an online survey of thousands of respondents and analyzed using factor analysis to determine which questions best measured the financial well-being construct. And several more rounds of surveys and item response theory analysis were then conducted to further refine the selection of questions to the 10 that provided the most reliable financial well-being scores, and also to figure out how each response to each question contributes to the overall financial well-being score. And as a final check, once the scale had been put together and the scoring procedure developed, the scores were then compared through other data that we collected in the same survey to theoretically related concepts like income, credit score, self-assessed financial situation, and experience of material hardship to make sure that our scale was actually measuring the intended concept. So we made sure that, for example, people experiencing a lot of material hardship would not score highly on our scale. Income is no means the full story, but certainly people with higher credit scores and higher incomes do rate higher on our financial well-being scale. So that's just kind of a final validity check to make sure that the scale score is performing in the way you would expect it to. Okay.
Are we ready?
We're ready. Thank you for bearing with me. Next slide.
Slide 14.
Okay.
It is.
So without further ado, here are the 10 questions that make up the scale. I know some of you are looking at them either on the webinar or on the PowerPoint, but it's a short scale, and I'm going to read it in case anyone is just listening on the phone. So for the first 6 statements, the respondent is asked, how well does this statement describe you or your situation? And the response options are completely, very well, somewhat, very little, and not at all. The statements are 1, I could handle a major unexpected expense. 2, I am securing my financial future. 3, because of my money situation, I feel like I will never have the things I want in life. 4, I can enjoy life because of the way I'm managing my money. 5, I am just getting by financially. And 6, I am concerned that the money I have or will save won't last. So those are the first 6 statements. For the last 4 statements, so together this makes up 10, the last 4 statements, the respondent is asked, how often does this statement apply to you? And the response options are always, often, sometimes, rarely, and never. These statements are 1, giving a gift for a wedding, birthday, or other occasion would put a strain on my finances for the month. 2, I have money left over at the end of the month. 3, I am behind with my finances. And 4, my finances control my life. So the respondent's answers to all 10 of these statements can then be used to produce one numerical score, and Hector will walk you through the process for doing that in just a few minutes. Okay, next slide. Okay, So now let's talk about putting the scale to use. You know how we developed it. You know what the questions are. You know what a scale is. So this scale, to remind you, it's designed to allow practitioners and researchers to quantify and therefore observe something that the respondent already has a sense of, but no one else can directly observe it about them. So the purpose of the score produced by this scale is to help professionals quantify and compare scores across time or across individuals. By that I mean see how somebody is doing over time and how their score might change, or to compare two individuals, two groups of individuals, et cetera. And also to study the relationship between financial well-being and other factors, which is a question of great interest to us, and from my conversations with a lot of colleagues outside the Bureau is of interest to a lot of others as well. So the scale can be used by practitioners to take an initial assessment of a client or to track their progress over time. In addition to assessing a person's financial well-being at intake, so the first time you meet with someone, you could have them fill out this questionnaire, you could produce a score, you could keep a record of that for yourself, and you could, think about what that means in the context of your serving the client. But also, reviewing the individual questions that make up the scale with a person that you serve can also help guide a conversation about their financial situation, both their strengths and their needs, in terms that resonate with and motivate consumers. Remember, the wording of all of these items originally comes from our open-ended interviews with a very diverse group of consumers. So the hope is that in addition to the quantifiable nature of the scale, the individual questions may be a sort of a useful and resonant way to open some conversations that may be relevant in your practice. And of course, the scale and the score produced by the scale can be used to track changes in an individual's well-being over time. And so that then relates to the next point, which is that the financial well-being scale provides a tool to measure the extent to which programs or any other financial capability initiative is improving the financial well-being of the individuals that they serve. To that end, the scale could be used as part of reports on the effectiveness of programs and services, such as financial education and capability programs. It can also be used to compare different populations in one program. For example, how a particular intervention differentially affects different people, or to compare changes in financial well-being across programs. So that's what's neat, to go back to this point about the way in which our sort of large and diverse field serves consumers to support their financial decision-making and financial outcomes varies so much. One program might be explicitly working on credit building, someone else on savings, someone else on, bill payment, or any number of other things. And this financial well-being score is something that can be used as kind of a common metric across programs that may have a very different kind of internal performance metrics depending on the goal of the program. And then, of course, finally, it can also be used by researchers in survey research to study the relationship between financial well-being and other factors, or in their program evaluation efforts.
I'm going to go to the next slide in just a second because Jen is giving me that look that says go to the next slide. But I just want to note, based on things I've heard from people before, this is a subjective scale. It is not measuring credit score into all the things you guys may be measuring in your programs. And you say, hey, it's not there. So this is not meant to be used in and of itself. I know you're going to be saying, okay, I jumped the gun, I'm sorry. But I know people look at the questions, you're like, but where are the numbers?
Right.
Okay.
Thank you.
Oh, look.
For that nice setup, Irene.
Okay. 516.
So, as my final note, this will be my last slide, and then I'll turn it over to Hector. I wanted to emphasize precisely Irene's point that this financial well-being scale is a complement to, not a substitute for, existing program metrics or direct outcome measures relevant to a program's goals, which again could be credit score, could be debt reduction, could be savings increases, or any number of other things. And so every program has other things that it needs to track for their operations, for their performance measurement, for their reporting purposes. And again, this is really meant to be a complement to that. And so what I want to emphasize about the complementary nature are the following 3 points. So this scale really adds 3 things in a very complementary way to existing measures of program performance that you are likely already using. The first is that it's a holistic outcome metric. So that's unusual. It's sort of this overall sense of success, a holistic outcome metric that reflects success in a consumer's own terms and allows for variation in individual preferences and goals. And that's a huge one. That's very, very hard to do. And as Irene pointed out, which is completely true, we're not asking people hard numbers. We're not asking them their credit score. We're not asking if they have 3 months of savings. We're not saying that these things don't matter. We wanted to have questions that people could apply to their own situation and could be equally relevant across different adult situations. So that's why purposefully you don't see any kind of hard numbers in here. And I think the value here is that because you don't see those hard numbers, this allows for variation in preferences, goals, and circumstances. And it's why it's such a nice complement to, the hard data that we all traditionally like to have for good reason. Secondly, it's a rigorous and simple way to measure important but traditionally hard to quantify success factors, like feelings of empowerment, confidence, and satisfaction. I think we all value those things. We all know that we care about them for clients and consumers broadly, but traditionally it's been very hard to kind of have a rigorous and simple way to quantify those in a way that you can then use in a sort of a reporting or more rigorous quantitative analysis way. So this does contribute that as well. And finally, I think I mentioned this before, but this measure can be used as a common metric across very different types of financial capability programs and interventions. So those are all the reasons why I would make a pitch that this is deeply complementary with what folks are already doing and adds some important new information that I think all of us are going to care about. So with that, I will turn it over to Hector.
Great. And I just want to note there are a couple emailed questions that I've gotten, but I'm going to wait till after Hector because I think they may be either partially answered or they'll fit better. So those of you who are emailing questions, keep doing so, but I will get to them in a minute. Okay, we are now on slide 18.
No, you want 17.
Oh, sorry. Slide 17.
Good afternoon, everyone, and thank you, Jen and Irene. I'm Hector Ortiz, and I am with the Office for Older Americans, and we're part of this project. And one of the things that we're very enthusiastic to see, as Jen mentioned, is this idea of understanding how financial well-being connects to other factors. In our particular population, how it relates to many of the financial capability programs that are being adopted for older consumers and retirees, certainly issues related to fraud, cognitive decline, health issues, fixed incomes. So a lot of opportunities with this scale. I will be discussing today how the financial well-being scale scoring works, but also how to interpret the scale. As Jen mentioned, the score that we use for the financial well-being scale, it's based on an item response theory analysis, and this method, very similar again to the SATs and other standardized tests, what it does, it gives us a more precise individual estimate, because what it does, it allows different items, so each one of those responses to contribute differently to the final score. The IRT-based scales are typically scored automatically and virtually through a software. But in this case, what we did was we created a lookup table to make the scoring process available to users and practitioners like you who may not have access to that specialized software. In order to do this, it requires what we call a two-step process, and I will be demonstrating how that two steps work. The first step generally consists of adding up what we will call the raw or total response value of to the different questions, and the second step will use the lookup system to find the corresponding final well-being score on the scoring sheet. And one of the key ingredients of that process is to also look at that score in terms of its difference based on the respondent's age, as well as whether the questions were administered by the individual to himself or herself, or if it was administered by someone else. And so I will show an example of that. Next slide.
And this is slide 18.
So this scoring sample in step 1 is for a consumer between the ages of 18 to 61. These are consumers that we generally call working age Americans, but again, this example could have been done also for the older consumers. What you will find in both the user guide as well as in our website, a set of scoring sheets, and the first sheet contains the scale with the spaces where you can report the consumer's answer, or the consumer can administer the scale to himself and herself and answer the different questions. The second step of the scoring process, once you have recorded those answers have a numeric value that needs to be added up. One important thing to note here, as you can see, some of the answers are reverse coded. So you will have places where the value of 4 belongs to completely, while the value while some completely value is 0. So be mindful of the reverse coding when doing this step 1. Next step. Next slide, Irene.
Yep, slide 19.
Thank you. And the second step is where once you have those answers and you have recorded the total score, the next step is adding up all of those responses. In this case, it's a total response value of 12. And using the lookup table based on the age of the consumer as well as how the questionnaire was administered. In this case, there's 2 modes. One is self-administered, the other one is administered by someone else. The way we tested this was through the phone. In this case, where it's a younger consumer, again, 18 to 61, who self-administered, the total response value of 12 corresponds in the lookup table to a total final financial well-being score of 40. If that individual had been an older consumer, that value would have been 42. Next step. So when it comes to interpreting the score, no worries. The financial well-being scale score is a standardized number between 0 and 100 that represents the respondent's underlying level of financial well-being. The number itself doesn't have a meaning on its own, and most people's scores certainly will fall in the middle, so like a typical curve, with extreme low values and extreme high scores being very uncommon. A higher score in our scale certainly means and indicates a higher level of measured financial well-being, but there is no specific cutoff for good or bad financial well-being score. The scores are new, so they have not been around long enough for research to establish a meaningful range for different levels, but also there is an opportunity for professionals like you to establish your own benchmarks as you use the scale with your clients and analyze those scores in relation to other data that they may have in their financial situation, but also as an aggregate for your clients. Next. And so generally, it's important to discuss what broadly this scale does. Generally, it's unique because it provides a consumer-driven measure of financial well-being that it draws on the insights from both consumers and experts. Secondly, it's a measurement tool that was developed using state-of-the-art techniques, including cognitive interviewing, testing to ensure the accurate comprehension of the questions. And the scale is highly reliable and valid measure of financial well-being construct based on multiple ways of quantitative testing. Third, it's a common metric that will allow us to do apples-to-apples comparison of scores across consumers, and as you could see, not just across consumers of different ages, but also consumers depending on the mode that you administer the scale. The scale can be used to assess the current state of financial well-being, but also can be used to track progress over time and to understand how other factors, program interventions affect financial well-being. Lastly, and it's important to mention this, it is free. It's a publicly available instrument and measurement scale. The guide, questionnaire, and scoring sheets are in our website, and you're welcome to use it. Contact us again if you have questions.
Great. Thank you so much, Hector and Jen. And I just want to add, too, again, that the scale, there's no sort of right answer to it. Higher is better. But each of you in your own practice may say that, gee, in my experience, people who have a 60 are pretty good, or maybe they need an 80, or maybe people of certain other characteristics may do better with a certain score. So it's a tool you can kind of use in your own way, but at least you can compare across your own populations and those of others. But it's really kind of requires you to do some work to figure out how to really make it work in your own setting until we have more kind of national data on that. So what I'm going to do is we have a bunch of emailed questions which are very interesting, but first I'm going to have the operator give instructions for voice questions, so you can all start to tee up voice questions as well. And once she does that, I will start to read some of the webinar questions for Jen and Hector to answer while you are also phoning in your voice questions. Operator, can you give us instructions?
Sure, thank you. At this time, if you'd like to ask a question, please press star followed by 1 on your touch-tone phone. You will be prompted to record your name prior to asking your question. To withdraw your question, you can press star 2. Again, that's star 1 to ask a question.
So we have several questions which are fascinating, and they range from I'm concerned about this is weird, to this is fantastic, which is great, which leads to great discussion. But I'll start reading a couple of them while others of you may be teeing up your voice questions. The first one, and this I think is the one we kind of expect, can you compare and contrast this scale to the financial capability scale from the group at University of Wisconsin Center for Financial Security? Genevieve.
Thank you. I will take that. Great question. I really appreciate it. The simplest way to answer it is that they are measuring different constructs, although theoretically related for sure. So our scale, let me start with, is meant to be measuring someone's experience and sort of kind of current state of being. And the idea, in theory, is that people with greater levels of financial capability would then be able to, take actions and order their financial lives such that they would be experiencing greater levels of financial well-being. So our financial well-being measurement is definitely not the same thing as the concept of financial capability. It's more the state of being that's meant to result from higher levels of financial capability. So the Financial Capability Scale is a terrific resource from University of Wisconsin that was also quite thoughtfully and iteratively developed, which is meant to be a tool to measure that construct of financial capability, by which I think they mean the behaviors and attitudes that would support having higher levels of financial well-being.
Great. Thank you. And actually, because I know there may be some, can you also tell us how it differs from the Center for Financial Service Innovation's financial health scale?
Absolutely.
Our survey.
And another great question, Irene. And I would say that our construct is deeply complementary with that one. Those of you who are familiar with the financial health metrics work that CFSI is doing, they are really looking at those nuts and bolts kind of financial ratios and more traditional objective financial metrics. So that's incredibly complementary. They're focused on these kind of objective metrics of financial health and, debt to income ratio, total amounts of savings, that financial, and their work is geared at financial institutions to help them understand the sort of objective financial health of their consumers. And again, the difference is that our work is focused on this more subjective construct of, if people are experiencing security and freedom of choice. And so the value of that objective information is huge, and we're adding how people are experiencing their lives. and ours allows for, I think, a broader range of variation, again, in preferences and goals, because it's not objective, and theirs adds the extremely valuable information of being the more traditionally objective kind of financial planning metrics.
Great. Let me just see if there's a phone question. I have a bunch more emailed ones, but let me ask about phone.
At this time, I'm showing no questions.
Okay. Can you again say it's star?
It's star 1 to ask a question.
Okay, great. All right, let me take, let's see, there's so many to choose from here. All right, I'll do it in the order in which they came in. So someone said, I looked at the questions and they were great, but I found the choices for the answers to be very weird. I'm concerned, how do you answer questions well? Quite sure what.
Yeah, I'm not sure what well means, but the answer categories essentially, it's not a yes no. It's sort of not a binary. I am concerned or I am not concerned. It's kind of like, how much of an issue is this for you? How well does this statement describe you? So, I mean, we went through a lot of testing of the answer choices and the framing of the these kind of, how well does it describe you and how often is this your experience? We pretty carefully tested those, the option responses as well, to make sure that these were the ones that were contributing the best value. So I guess all I can say is there's a range of options. People can choose the answer that they think most represents their experience and their situation.
Great.
And we have very much tested the individual responses and response options for their reliable contribution to the scoring.
And then on the flip side, we have another question saying, these questions are fantastic. Do you have a national benchmark number to track against regularly?
Well, a national benchmark number is one thing. Regularly is another. What I can tell you is that this is, this is brand new. We didn't say this, and some of you may not realize this, but we just published this scale and scoring procedure about 6 weeks ago. So it is brand new. That's why Hector was saying that data has not been collected that would allow us to kind of establish levels and benchmarks. That being said, the Bureau is actually, we are in the midst of designing a nationally representative survey to get, for the first time, benchmark population metrics of financial well-being using this scale and scoring procedure. So stay tuned. I don't think that data will actually, I don't know if you know the pace of government research, but we are starting that project, and information on that probably will be available in another couple of years.
Right. And I will say there are also others who are planning to use these questions in other survey research. So we may get numbers from other.
We very much welcome that, and to the extent that other people are farther down the road with their survey projects and have the ability to gather data using this scale more quickly, we know some people are considering that, and we welcome that and think that's fantastic.
Okay. Next question. Actually, let me pause again. Any phone questions? Operator?
Yes, we do have a couple of questions. Kathy Swedler, your line is open.
Oh, Kathy.
Kathy Swedler of University of Illinois Extension, your line is open.
Thank you. I'd like to go back and ask for a little more clarification between the financial capability scale and this financial well-being scale. As an educator in the field, can you give me maybe an example of when I might want to use one versus the other?
That's a great question. I'll start out by saying that, again, they're measuring different constructs. So I think I would have to say, I think that the financial well-being scale is very broadly relevant across a range of any financial literacy or capability service or intervention serving any adult. And I do want to emphasize that this is an adult construct, and it's one that was defined by and the scale tested on adults. So I would not recommend the use of this financial well-being scale with young people who are not kind of managing their own finances. But really, any financial literacy capability or other type of intervention serving any adults in the U.S. generally, I would say this scale is relevant for in terms of understanding the connection between understanding the financial well-being of the folks being served and understanding the connection between the intervention and improvements in financial well-being. So I feel like I can speak much more confidently about when I think it would be appropriate to use our scale. I don't really want to put words in the mouth of the folks at UW about the circumstances in which they think it's appropriate to use their scale, but it was created with a specific set of kind of empowerment type programs, financial coaching and other things, with an eye toward kind of the intermediate program performance metrics that would be relevant for those programs. So I think I'll just have to leave it there and say it just depends. I really would say it depends on which construct you're looking to measure in terms of program outcomes. Does that make sense?
It helps some. Thank you.
Yeah, I mean, one of them is specifically looking at behaviors and attitudes, and the other is looking at your experience of your financial situation. So I think often they would be very complementary, and it would be very interesting to know if you can improve on the financial capability scale. Does that also improve your financial well-being? Certainly we would theoretically think so, but we haven't tested that in the field.
Right. I mean, I'll just add something because we've certainly heard this question before, which is that the financial capability scale asks some sort of self-reported but objective behavioral questions. Have you paid a bill late in the last 2 months or something to that effect? So that, in some ways, is going to measure a set of financial stress, perhaps if someone's not paying their bills on time, but it's not going to measure the subjective sense of I'm managing my finances well. I mean, again, the financial well-being scale is a subjective measure of someone's own sense of well-being. The financial capability scale is saying if you're paying your bills late, that's a problem behavior.
Right.
You may interpret, I mean, probably you're stressed and you're going to say your well-being will be lower, but
yeah. I would just guess in most, I mean, I don't think that these two scales are really ever substitutes for each other because they're not measuring the same thing. Often, I think it would make sense to use both if the behaviors and attitudes that are measured in the capability scale are something that you think should be an outcome of your program intervention.
That helps a lot. Thank you.
All right. We've got, let me take another. Here's a very straightforward one. I'm curious about the scoring difference for someone who had the questions read to them versus did this on their own. What is the thinking behind scoring these things on a different scale?
Okay. So I'll answer that in two stages. The first is that it's, you know, a pretty well-known phenomenon in survey methodology that there is kind of a systematically different way that people answer questions if they read it to themselves versus if it's read to them by someone else for two reasons. The first is this sort of maybe you want to please the interviewer and you're more likely to have your answers, you know, seem more socially acceptable or something, so there's the possibility of that type of bias. And the other is just literally a kind of memory thing related to whether you hear something or see it written. So, for example, if I gave you a series of options verbally, you'd be much more likely to remember the final option I gave you, whereas if you were reading all of them at once, you know, you'd be just as likely to realize that you could answer all 5 of those options. So there are just some kind of well-documented systematic reasons why people may kind of systematically respond to questions slightly differently depending on if they read it to themselves or someone else read it to them. So that's the theory behind why we investigated if that would be the case here. And so in order to investigate that, we did test the questions both online, where people self-administered, and in phone surveys. And we did find that, as expected, there was a slightly systematically different, slightly different way that people responded, and so the scoring accounts for that.
Just out of curiosity, is it always higher if it's in person, or is it not align in such a simple way?
I don't think it's as
okay.
simple. It's just that there's good reason to think it might be different, so you should check for it.
Right.
And we checked for it, and it was there, and that's why our scoring corrects for it.
Okay. All right.
I say that as not actually a survey methodologist, so that's my answer.
All right. I still have more email questions, but let me do another check for phone questions. Operator, do we have any?
We do have another question. Ellen Joseph, your line is open. Ellen Joseph of Gesher, your line is open. Can you please check your mute button?
All right. His was one of the emailed questions, so maybe he felt has been answered. Okay, let me ask another one of the questions through the Q&A function here. How do you recommend that organizations use this scale to track aggregate changes in financial well-being among clients? can you provide an example of how those results might be conveyed to stakeholders?
That's a great question. Hector, do you want to jump in on that, or should I?
Yeah, go ahead, Jen, and I will have other thoughts.
So that's a great question, and actually, I have a pretty simple and straightforward answer to it. Because these scores can be directly compared, as long as you properly calculate each individual score, and by that I mean, as long as for each individual you get their score by using the proper age category and proper mode category. And for practitioners, I don't know if you're likely to be using both modes, so it may not even be an issue. But if you are, the point is, every time you assign an individual financial well-being score, just make sure that you're using the proper age category and the proper mode category. And then once you've done that, the scores are all directly comparable to each other, which means that they can be aggregated completely. There's no problem with doing that. So in the simplest way, you can just do any simple summary statistics you want, aggregating or analyzing all those individual scores together. And then the question of how would you report on them, it's a great question. So this hasn't been used in the field yet. The things that would come to me top of mind are, you probably would want to talk about aggregate changes in raw score and aggregate changes, percentage-wise, any kind of distributional differences that you notice in scores changing for different groups of people if you want to. And the other thing I'll mention for the people that are interested in thinking about it in this kind of way is that, based on the many thousands of people that were part of the original testing of this scale, which was a large and generally diverse pool of American adults, although not technically representative, because we weren't using a perfectly representative sample, the mean score is around 50, and a standard deviation is about 15. So if you were interested in thinking about did someone improve, how much of a standard deviation, here it's about 15. So for people who would actually want to get into that in their reporting, I'll tell you that, but otherwise, some simple, my group, is improving this many points or this percentage of points might be fine too.
Right. And then I'll actually answer a different version of that question, which is if you consider stakeholders to be your clients, in discussions with some practitioners we've already had, people have kind of brainstormed as a group and say, we don't think giving the number to clients is a good idea. Again, this is up to whoever uses it, however they want to use it, but the idea that because the number, there's no benchmark yet, which someone raised earlier, there's no benchmark, there's no sense of whether 50 may be average, but is that good or bad? The practitioners that I've talked to have said, we would tell consumers you're improving, or use it in other ways, or give it color codes or something other than saying you got a 50, which
right.
If you are used to an academic world, 50 is failing, and that's not what this is meant to say. So that's just a thought about if and how
right.
and how you want to communicate it to your clients. Obviously,
right. That's a really
caution.
important point. An individual score is totally meaningless in isolation right now, especially because we don't have any national benchmark data. So exactly, I think talking with a client, you might say, okay, this is how you answered the questions. Would you like to be able to answer any of them differently? Is that a goal you have? If so, we can now talk about steps you could take. And then the next time you see them, if you administer it again, you can say, oh, it looks like your financial well-being has improved. It looks like you're answering these questions differently. So, yeah, if the point is to talk about it with the client, I would do it in that way and not focus on the number.
Right, and just the other thing practitioners have said so far is that separate from all the cool research stuff and all the things Jen talked about, just as a coaching tool or conversation starter to say, gee, you said buying a wedding present would put a strain on your finances. Let's talk about that. Or you don't feel secure. Your finances control you. What does that mean to you? Let's talk about that and start the conversation. Whatever the numbers are, the questions themselves, I think could be helpful in that context. So let's see if we can squeeze. We just have a minute left. If we can squeeze any of these other questions in. There was one about whether we're going to do a larger scale assessment, and I think through your survey we are.
Mm-hmm.
And then
we are, and other people might be, and
right,
that would be terrific.
Right. And then when using it as follow-up in a group setting, is it necessary to match up before and after individual scores? Would it be okay to compare the average before or after scores of the group?
So that's what I wanted to make a quick contribution, Irene, that we say this in our Q&As and the actual guide, where we note that it's important to know that small changes in the scores due to answering the questions. It happens, but at the same time, there is typically a margin of error associated with the testing of this scale. So sometimes those small changes are not meaningful on themselves. So there's again in our user guide we provide other key tips about considering individuals who are considering and professionals considering using the scale.
Great. Okay, we're just about out of time. Out of curiosity, operator, do we have any other phone questions? I hope the answer is no.
I'm showing there's no questions at this time.
Excellent.
Can I actually answer the question about averages?
Yes.
So thank you for that question. Let me say this. I think that as long as the same people were part of the group at both times that you surveyed them, there's nothing wrong with taking the group, a change in the group average. You don't know what happened to any of the individuals, but it's reasonable to say the group overall was doing better than they were at the beginning, as long as all of the exact same people were surveyed before and after, if that makes sense, because otherwise changes in the group composition could be driving the effect. Thanks.
Great. Well, we are right at time, a few minutes after, so I want to thank everybody. Again, this is a new thing. There's a lot more learning to be done about it. We'd like to have all of you kind of participate in that learning by trying it out in practice if you are interested. It is all available on our website, as Genevieve said. And again, all of you who are part of Finex already, the link was also included in that little newsletter that went out earlier this week. So thanks again. We really appreciate the speakers and all the participants, and we look forward to having you hopefully on our next Finex webinar. Thank you very much.
That concludes today's conference call. You may disconnect at this time.